This idea of digital money, a currency that exists just as pure code, it's been absolutely revolutionary. But right from the start, it had this one massive, fundamental problem that kept it from, being used in our actual day-to-day lives. So let's just jump right in with a super simple question. Why can't you just walk into a coffee shop and buy your latte with Bitcoin? I mean, it sounds like something we should be able to do, right? Well, the answer to that really gets to the core challenge that these early cryptocurrencies had to figure out. And that challenge, really, it all comes down to one word: volatility. The price of something like Bitcoin can just go on a wild ride, swinging up and down in a matter of minutes. Just think about it. You pay, say, $5 for your coffee, and by the time you finished your last sip, that same amount of Bitcoin could be worth $3 or maybe $8. That kind of instability just makes it completely impractical for everyday stuff. And here's the thing, right? This crazy volatility means that early crypto just couldn't do the three basic jobs we expect and need our money to do. It can't be a reliable way to exchange value, to buy things. It's a terrible way to save your money if its value could just plummet overnight. And you definitely can't price goods with it if the price tag is effectively changing every few minutes. So, to fix this exact problem, to create a digital currency that you could actually use to buy that cup of coffee, a whole new kind of digital asset had to be created. And honestly, this was a total game changer. And that's where the stablecoin comes in. The whole idea behind it is actually pretty simple, but it's incredibly powerful. It's a cryptocurrency that's specifically built to hold a steady value. And it does this by being pegged, or kind of locked, to a real-world asset, usually a big one like the US dollar. The goal is always one stablecoin equals $1, period. And that's why this is such a perfect way to think about them. Stablecoins are really this essential bridge, connecting the old world of traditional finance that we all know with the brand new, fast-moving crypto economy. They let you get the stability of the dollar, but with the speed and the global reach of a cryptocurrency. Best of both worlds. Okay, so what do these things actually do out there in the real world? Well, they've become totally essential to the digital economy, and they basically have three key jobs. Let's break those down. And they do some pretty crucial stuff. First off, they're basically the lifeblood for crypto traders. Traders can zip out of a risky asset like Bitcoin and into a stablecoin to lock in their profits, and they can do it 24/7 without the headache of cashing out to a bank. Second, and this is huge, they're a total game changer for sending money around the world. We're talking minutes and pennies and fees instead of days and high costs. And finally, they are the absolute bedrock of what's called decentralized finance, or DeFi. They're the stable stuff you use for loans, borrowing, and all sorts of other financial applications. Now, obviously, this stability isn't just magic, right? That peg to the dollar has to be maintained. The idea is, for every single stable coin that's out there, the company behind it is supposed to have one real US dollar or something just as good tucked away in a bank account somewhere as a reserve. That backing is what gives the coin its value and keeps it stable. Okay, let's pull back for a second and look at the bigger picture here. Because when you really dig into it, this whole journey of digital money, it's not just about technology. It's a story about a very human idea: trust. Who or what are we willing to trust with our money? You see, if you trace the path from Bitcoin to these stablecoins we're talking about, and then you look ahead to government-backed digital currencies, what you start to see is this really fascinating trust spectrum. Each one of these represents a totally different answer to that fundamental question of trust. And this table really lays it all out. So look at it this way. On one extreme, you've got Bitcoin. Your trust there is completely decentralized. You're not trusting a person or a company. You're trusting the math, the code, and the economic rules built into the system. Then, smack in the middle, you have these fiat-backed stablecoins. Here, you're shifting your trust to a centralized private company and its auditors. You're trusting that they're doing what they say they're doing. And then all the way on the other side, you've got the idea of a central bank digital currency, or a CBDC. And that's the most traditional model of all. You're putting your complete trust in a government and its central bank. And you know what's interesting? The market has kind of already voted with its feet on this one. After some early controversies about whether these stablecoin companies really had the cash to back up their coins, people started moving their money to the ones that were willing to open their books and get regular, transparent audits. It shows people really want a trust model that they can verify, even if that means trusting a private company. And all of this brings us right back to that one huge final question that this whole evolution forces us to think about. As we go deeper and deeper into this new era of digital money, the choice isn't just about the tech. It's about who or what you trust. Is it the pure math of decentralized code? Is it a private company with auditors? Or is it the full faith and credit of a government? At the end of the day, who will you choose to trust?